Hello, this is Elizabeth Pluswick, and today's short video is on depreciation expense. There are two popular definitions, uses of that word depreciation, and so we'll look at the popular one first, and then the one that is more business-oriented, that more applies to economic analysis. The more popular definition of depreciation, when your car depreciates, when you drive it off the new car lot, for instance, is a decline in market value over time. So depreciation is said to describe a decline in market value. So the market value is whatever a willing buyer and seller negotiate as the selling price. And over time, that selling price goes down, so assets generally lose market value or depreciate as they get older. Okay, that's kind of the popular definition, use of that word depreciation. And that's fine, that's accurate. There's another use of the word depreciation that is more relevant in accounting and business that we need for the best analysis of cash flows of assets. So here's the business definition, kind of formal, for depreciation. It's the systematic allocation of an asset's cost over its useful life. So the original cost of the asset divided by its useful life, or some other systematic allocation of that asset's original cost over time, over the time that it's used to produce goods and services that will be sold. So all of these assets we're assuming are used to produce sales revenue, and the depreciation expense is simply writing off the original cost of that asset over the time that that asset is producing revenue. Okay, so here's an example of the straight line method. We're going to look at three different methods of computing depreciation. The first one is called the straight line method. That's real simple, where you take the original cost of a machine, in this case $10,000, and simply divide it by its expected useful life. Then its annual depreciation expense is $2,000. If the asset is expected to be sold at some point in the future for a salvage value, you estimate how much that asset will be sold for, then subtract that from the original cost, and then divide the result here, divide that by the asset's useful life. So again, the business definition of depreciation is just the allocation of this initial cost of a machine over some useful life. Depreciation expense then is an expense on the income statement. So let's just take a real quick look at an income statement. We'll get back more to this later on, but just simply to show you where that depreciation expense comes in. Here's an income statement for year one, sales revenue, minus a whole bunch of expenses, including depreciation expense. There's our $2,000 right there on the company's income statement. So sales revenue, $100,000 minus all the expenses. Here there's $72,000. Give this company net income of $28,000. And that $2,000 depreciation expense will be consistent over the entire, here I've just laid out 3 years, but it would be the full 5 years of that asset's life. The depreciation expense we compute once when the asset is purchased, and then rationally allocate that expense over the full 5 years that it's owned. 1/5 or $2,000 every year in this case. All right, in your Chapter 15 Engineering Economics Study Guide, here on page 622, it talks about depreciation expense. This first one is straight line depreciation. So the formula here is BV is book value, C is the cost of the asset initially, D stands for depreciation in any particular year for the subscript, and then S is salvage value at the end of the asset's life. So there we've got the definition of depreciation Book value is cost minus accumulated depreciation over all the years that it's been depreciated since the asset was purchased. And here's the formula that we just went over. Here's the formula, though, to compute straight line depreciation. Depreciation expense in any year equals cost minus salvage value, and then divided by the asset's estimated useful life and its number of years. So I want you to know, you'll need to know straight line depreciation as one. Then the other one I want you definitely to know is modified accelerated cost recovery system. MACRS, right? And this is from the tax law. This is tax code, and it is very, very simple. On the next page, you'll see a chart that looks like this. And it's very simple. You simply multiply the cost of the asset times an appropriate percentage from this table. This table comes from the tax law. What you need to know is the asset class, and the IRS sets these up. Computers are for instance, in the 3-year category. Light use vehicles are in the 5-year category. Heavier trucks and much machinery is in the 7-year class. 10-year class are even longer lived assets. But the IRS, you don't probably have to worry about what asset class they go in. The accounting department will figure that out. But any asset has a particular year that the IRS has said is its estimated useful life. So that's going to be given to you. And all you need to do to compute depreciation, in order to compute cash flows more accurately, is take the cost of the asset, initially, here again, $10,000, times the appropriate percentage. So here, I'm in a 3-year asset. That's the category of my asset. And in the first year, this is a percent, 33.33 multiply. So depreciation expense in year 1 is $3,333. And then you just go down the column. You stay in your asset class column and just go down to year 2. So year 2 depreciation is, again, the initial cost, $10,000, times the next percentage in the column. For year 2, 44.45%. So just take the asset cost times the appropriate percentage, and there's depreciation in year 2 of that asset. And continue on for years 3. And a little bit, you'll see it's a 3-year asset, but a little bit tailors over, carries over into year 4. Why? Well, the IRS uses a half-life convention where they really only give you half a year's worth of depreciation in year 1, and then a full year in year 2, and then in year 3, and a little bit tails on into the year after the end of that normal, what you'd expect to be the end of the schedule. A little bit goes over to account for that half-year convention. Same thing here, like in the 5-year class, really, the full depreciation expense for the year is 40%, but the IRS only gives you half a year's worth in year 1. So a little bit, even though it's a 5-year life category, a little bit extra depreciation comes on in year 6. That's the end of that half year. So for modified acres for tax purposes, simply cost times the appropriate percentage from the table. Key thing, ignore salvage value with modified acres depreciation. Always start with the asset cost. Do not subtract salvage value. Ignore it for purposes of tax depreciation. Always start with the full asset cost. Even if there is an estimated salvage value, the IRS says, let's ignore that. It's an estimate way in the future. We're not going to worry about it. So just always start with the cost times the appropriate percentage to get that year's depreciation expense. Okay, there's one more type of depreciation expense that I want you to know, and that is called units of production. And that is where depreciation expense is calculated based on use. So as the machine is used up, it's depreciated. So for instance, again, $10,000 cost of the machine, and let's say the machine can run 10,000 hours in its life. And this year we ran at 3,000 hours. So we've used up 30% of its life, 3,000 divided by 10,000 total use, total life. We've used it 3. So that year, then we would have $3,000 of depreciation expense in year 1. Say in year 2 we use it, 2,000 hours, it would be 10,000 times 2 over 10, or $2,000. If, for instance, in 1 year, say a different machine, or pretend that this didn't happen, if we just used it 7,000 out of the 10,000 years in 1 year, then its depreciation expense that year would be $7,000, simply based on how much did we use it that year divided by its total life expectancy. Here I've used hours, but this could also be in number of units put through the machine. If it can only make so many pieces before it wears out, then that would be your denominator. It's total expected use. Okay, so you've got 3 methods: units of production method of computing depreciation expense, the tax method called modified ACRS, and then the very simple straight line method, and that is where you subtract salvage value from the initial cost. That's the simplest one to do. There's depreciation. Thank you.